Hello, it's Monday, the 16th of March, 2009, and this is Brian Shannon from AlphaTrends.net. We had a little bit of pullback in the market here today, and we've been expecting that a little bit here as the market has gotten extended on lighter volume. As I had said yesterday in the live analysis, that the market seemed like it was getting a little long in the tooth and running on fumes in here. Today we saw a little bit heavier volume as the market pulled back, and it came just below that declining 50-day moving average. The more important level of support for this market is going to continue to be down near about this 28, just under 28 level. That's where we had seen prior support turn into resistance. When we look at a 30-minute time frame, that's about where we see the 5-day moving average as well. And then when you look at the move that we've seen since last Tuesday, if we take a look at the VWAP, the volume weighted average price since that move, and you can see that line moving, it ties in almost perfectly with that 5-day moving average. And you look at also, of course, we had a little bit of resistance there. So I think that about 27.80. If we break down through 28, I wouldn't be real concerned. As I had mentioned on my blog earlier today, that I had told my mom to get out of 25% of the original position. So if you remember, we had bought down here at 26.70. I had her get out of half of it at 28.30, and then I took half of that half, or 25%, out at $28.80 today. We've got 25% of the original position remaining. Her stop is going to be at $27.70. So on that final 25% position, if the market can hold above that level, I think it's got enough safety in there that she'll be okay. Meanwhile, there's been some great short side action today. On the blog, I had shown that the Nasdaq was underperforming here later in the day, and I made a scenario that maybe it makes a higher lower high rather, and then breaks down. And go back and look at Twitter and those twit picks, because they turned out to be some pretty good calls actually. Here on the daily time frame, though, again, we saw the volume pick up in here a little bit, so there's some real nervousness, I think. And if you hold on one moment, I just want to switch screens and get this chart up. This is the advanced decline line for the New York Stock Exchange, and you can see how rapidly this changed from 2,400 advancers down to 1,700 here in the last hour. So there was when the advanced decline changes that rapidly late in the day, it means that there's not a lot of confidence in the market, that people are really looking at this market, rightfully so, as it's extended. We're in a primary downtrend. They want to take some profits, and then let's see what happens. Maybe reload on some of those longs at a lower price. But if we look at since this move, since the low, we also see that down here that 2670 is a 1/3 or 38.2% retracement of the move from this low to this recent high. So another reason to think that that's a potential area of support. So maybe I'll have my mom put her stop at 2765, and I'm gonna write that down right now, because that's the official number for her final small position. So we've got the market looking like it's heading lower. We've got a rising 5-day moving average. So these short-term sell-offs are great to trade, but we've got a short-term declining market. Intermediate term, as evidenced by the 5-day moving average, is turning higher. The daily, we've got a big mess in here, maybe range bound, and the weekly time frame continues to be in a downtrend. So a lot of mixed messages across different time frames. That's when it continues to pay to be a trader, and with this massive volatility, really makes that case even clearer. The Russell 2000, we were looking at this last week. We were looking at the inverted head and shoulders pattern, and the height of this suggested a move up towards, I believe it was 41.5. Let's just take the height of this and grab it and add it to there. So it was about 41.5 that we were thinking had the potential based on that inverted head and shoulders pattern. And I said you'd have to be nuts to trade it, though, in that if you buy right here, you're just going to stick your sell order out there at $41 a share and think that you're going to come back and see it filled. You can't look at the market that way. You have to be more proactive and listen to the message of the market. When it starts making that pattern and here's what I'd said in the live video yesterday is basically we see these higher highs and then these higher lows. When that pattern of higher highs and higher lows is interrupted, it's a message to move to the sidelines, and you can see a lot of people listen to that message. Here on the 10-minute time frame of the Russell 2000, we came right down to a trend line that we can draw off of the lows from last Thursday to to this little pullback low, and we're seeing this market pull back down close towards that 5-day moving average towards the neckline. And also, if we look in here at the average price since this move, we're taking a look at the volume weighted average price right in here. The average price is right there at the 5-day moving average. So $38 is going to continue to be an important level, and just below it right here at 37.80. I think that's going to be more important. I think it would be very likely and actually encouraging to come down through the 38 level down towards 37.80 and then see the market stabilize and then maybe a rally to begin from there. But right now, you should be cash most of your longs out, scalping on the short side and looking for either some stabilization or a complete reversal and then back lower. As you know, the daily time frame here on the Russell is much sicker than what we've seen in the Nasdaq. So there's still a lot of reason for concern as far as this overall market goes. We've got a lot of nervousness, and rightfully so. The financials. This is the group that really came up nicely to a level where I had pointed out on the blog as well that that had come up to this prior level of support in here, which had been resistance, and also the 2/3 retracement of the January highs we'd see, or not the January highs, the February highs rather. Let me redraw that. The February highs here, we'd seen a 61.8% retracement right up to this level, and that's an area that a lot of people have been watching, obviously. So there was a reason to think that Fibonacci might bring some supply to the market or less demand. There was reason to think that this prior level of support in here that had been resistance would bring about a little bit more supply or less demand. Yesterday I had pointed out the potential for a bullish scenario for these financials, which is a nice inverted head and shoulders here on this time frame. So what we want to do is we want to obviously continue to monitor this. I had pointed out that this trend line had broken, and at that point that's also intraday where we had seen the market rallying right up. Here's where I pointed out that we had seen it looked like we were at a very important level on the 1-minute time frame and on the 10-minute time frame, because we're getting back up to that level, and that also coincided with that 61.8% retracement right in here and the prior support. So there's a lot of reasons to look for the reversal in there. Now the daily time frame, you can start to see that we have that low, this lower low, and now if we're going to create an inverted head and shoulders pattern here, we're just up to the neckline. We still may, if it's going to be symmetrical, well then maybe a move down towards 730, 740. Here's what we have as far as potential support levels. We've got this prior little level here that meets the market at about 770 at the 5-day moving average. If we take a look at the volume weighted average price of the XLF since just last Friday, we see here that level is very close to that 5-day moving average as well. So I think that maybe 7.5 is going to be an important area for this market to hold short term. If we put some Fibonacci in there, we've got 763. So maybe $7.60 is going to be the more important level. If we can hold $7.60, it won't necessarily create that symmetrical pattern here for an inverted head and shoulders pattern, but we could see that 760 basically is right here. Let me redraw that. $7.60 would bring us down right to this level. That's $7.60, and that would actually create a pretty nice little inverted head and shoulders pattern that if we could find support at that level, that would create this little inverted head and shoulders pattern. It would also create support near that 5-day moving average and a 38.2% retracement at this prior level. So 760 looks very important for the short term. Breaking down further, then maybe down towards $7 a share. But we've got a lot of cross currents across these multiple time frames, and it's great for day trades. When this thing fell apart, I was looking for it to move down to the 2-day VWAP and bought some FAZ right in here and traded it down towards there. Thought it was a great trade, but obviously I left a lot on the table. And again, it's not how I traded. It's about looking at these levels and making this analysis your own. So hopefully that's what you're doing. Let's look at the SPY finally. S&P 500 on this daily time frame, we can see that we're up to we're approaching this important prior level near the $80 area. Someone asked me, do I think it's going to get to 80? I don't try to impose my belief on where I think the market's going to go. I want to listen to the message of the market, and when it's showing higher highs and higher lows, that's great. When it starts breaking that pattern in the shorter term time frame, falls down to the VWAP, struggles with VWAP, gets above, and then fails, then that's what you have to listen to. You have to listen to price first and foremost. We can look at draw some trend lines in here. This this open last Tuesday to the pullback in here, we're right at that we're right at that trend line that seems to have held for today. That did hold for today. If we look at the volume weighted average price, right around that $74 level, which is about where we see the 5-day moving average as well. So below 74, basically, it means that the average person who's purchased the SPY or S&P futures or whatever you use to trade the S&P, basically this is the level where the buyers are still in control since this move, and that's only since the past week, since we've had this big move. But there's still really no reason to think it's anything more than a bear market rally. As I said, I'm holding a very small position for my mom just in case it turns into something else, but she's already realized a very nice profit, and it's almost impossible for her to get hurt here. We'd need a big gap down for that to happen. Job number one is always manage risk. We've got a lot of different messages being sent to us here on these different time frames, and this area at 74 is further added to as potential important area because it's where we had seen this gap lower and then act as resistance. So 74 looks very important in S&P 500. We've got a lot of important levels in this market. If the buyers are going to take back control, we need those support levels to hold, the market to stabilize, and then we can go to work on the next level of supply. And hopefully the market will continue to send us some pretty clear message on the chart.